Today, we're going to talk about money, but not in a complicated or intimidating way. We're going to talk about stock investing through simple, timeless principles. These ideas are inspired by one of the most successful investors of all time, Warren Buffett. Buffett didn't build his fortune by chasing trends, guessing the market, or making risky bets. Instead, he followed a few powerful rules that anyone can understand and anyone can apply. This audiobook is about 5 rules. They are not shortcuts. They are not secrets. They are principles built on patience, discipline, and common sense. Whether you are new to investing or just beginning to learn how money works, these rules can shape the way you think for the rest of your life. So take a breath, slow down, and let's begin. Rule 1. Never invest in a business you don't understand. The first rule is the foundation of everything in successful investing. Before charts, before numbers, before profit forecasts, there is one simple principle that must come first. Never invest in a business you don't understand. This rule alone has protected Warren Buffett from countless mistakes, and it can do the same for anyone willing to follow it. Warren Buffett often talks about something called the circle of competence. This idea is simple but powerful. Your circle of competence is the area where your knowledge is strong, where you truly understand how things work. It doesn't need to be large, and it doesn't need to be impressive. What matters is that it is clear. Buffett has always said that knowing the boundaries of your knowledge is more important than trying to expand it too quickly. If you don't understand how a company makes money, that is your first warning sign. If you can't explain in plain and simple words what the business does and why customers pay for its products or services, then you shouldn't invest in it. Investing should never feel like guessing. The moment you rely on hope, hype, or blind trust, you've stepped away from investing and into gambling. Many people buy stocks because they hear a popular name on social media, see exciting headlines, or feel pressure from others who claim they're making fast money. Fear of missing out pushes people into decisions they don't fully understand. But buying something simply because others are buying it is not investing. It's speculation. And speculation, over time, almost always leads to regret. Understanding a business means knowing a few essential things. You should know what the company actually sells and whether people truly need or value it. You should understand who its customers are and why those customers keep coming back. You should know how the company earns profits and what costs threaten those profits. And most importantly, you should be aware of what could cause the business to fail. Every business has risks, and understanding them is part of being a responsible investor. The good news is that you don't need advanced math, complicated formulas, or expert-level predictions. You don't need to forecast the future or time the market perfectly. What you need is clarity. Clear thinking beats complex thinking almost every time. When something feels confusing or overly technical, it's often a sign that it lies outside your circle of competence. If a company's success depends on technology you can't explain, or trends you can't reasonably understand, then it's probably not a good investment for you, no matter how exciting it sounds. Buffett famously avoided many popular industries during his career, not because they weren't profitable, but because he didn't fully understand how they worked. That discipline kept him out of trouble when others rushed in blindly. By choosing not to invest in what he didn't understand, Buffett avoided massive losses that destroyed other investors. He accepted that missing opportunities is part of the process. And that leads to the most important lesson of all. It is far better to miss a good opportunity than to invest in something you don't understand. In investing, Patience and understanding are not weaknesses. They are your greatest strengths. Rule 2. Look for businesses with strong and lasting advantages. Once you understand a business, the next question becomes even more important. Can this business remain successful for a long time? Many companies can perform well for a short period, but only a few can protect their profits year after year. Warren Buffett calls this ability a competitive advantage. Others describe it as a moat, like a castle surrounded by deep water, protected from attackers trying to break in. A strong business has something that competitors cannot easily copy or take away. This advantage creates protection. It allows the company to survive competition, economic downturns, and changing trends. Without such protection, even a profitable business can quickly lose its position when a stronger or cheaper competitor appears. Competitive advantages come in many forms. Some companies have powerful brands that customers trust and recognize instantly. Others benefit from loyal customers who return again and again, not because they are forced to, but because they want to. Some businesses operate at lower costs than their competitors, allowing them to earn profits even when prices fall. Others have earned a trusted reputation over decades, making customers reluctant to switch. And many of the strongest businesses offer products or services people use every single day, often without even thinking about it. Think about the companies you personally return to out of habit. You don't compare prices every time. You don't question the decision. That kind of automatic loyalty is incredibly powerful. It creates stability, predictability, and long-term strength. For an investor, those qualities are far more valuable than short-term excitement. A company with a strong and lasting advantage doesn't need to fight for survival every year. It doesn't rely on constant innovation or risky reinvention just to stay relevant. Instead, it builds value gradually. Its earnings grow steadily. Its position strengthens quietly. Over time, this steady progress compounds into something remarkable. Warren Buffett has always preferred businesses that are often described as boring, but dependable. Businesses that sell necessities rather than luxuries. Businesses that operate simply and efficiently. Businesses that can raise prices slightly without losing customers because their products are trusted, familiar, and hard to replace. These businesses may not make headlines, but they tend to endure. When a company has a true and lasting competitive advantage, time begins to work in your favor. The longer you hold it, the more powerful compounding becomes. And in investing, time is the greatest force of all. Rule 3. Buy at a reasonable price. Even the best business in the world can become a poor investment if you pay too much for it. This rule reminds us that success in investing is not only about choosing great companies, but also about choosing the right price. A strong business does not automatically guarantee strong returns if the price you pay leaves no room for error. At the heart of this rule is the difference between price and value. Price is simply what you pay for a stock on the market. Value is what that business is truly worth, based on its ability to generate profits over time. The stock market, driven by emotion and speculation, often confuses the two. Investors frequently treat rising prices as proof of value, even when nothing fundamental has changed. There are times when excellent companies become wildly popular. Excitement, headlines, and optimism push their stock prices far above their true worth. At other times, strong and reliable businesses are ignored, misunderstood, or temporarily affected by short-term problems. During these moments, their prices may fall, even though their long-term strength remains intact. Warren Buffett pays close attention to these differences. Rather than chasing excitement, Buffett waits. He understands that opportunities come to those who are patient. When fear, uncertainty, or market panic drives prices down, he looks carefully at the underlying business. If the company remains strong, stable, and well-managed, a lower price may represent opportunity rather than danger. This approach requires patience because good opportunities do not appear every day. It also requires emotional control because fear and greed often push investors to act at the worst possible moments. Buying when others are fearful and staying calm when others are excited is not easy, but it is essential. Buying at a reasonable price creates what Buffett calls a margin of safety. This margin protects you if things don't go exactly as planned, if earnings grow more slowly than expected, or conditions change slightly. A fair price helps limit your downside. It allows room for mistakes without causing permanent damage. Buffett once explained this idea simply by saying, "It is better to buy a wonderful company at a fair price than a fair company at a wonderful price." In other words, quality matters, but price still matters too. Successful investing lies in finding the balance between the two. Rule 4. Think long-term, not short-term. This rule clearly separates true investors from traders. Investors think in years, sometimes decades, while traders focus on days, weeks, or even minutes. Warren Buffett belongs firmly in the first group. He does not worry about daily price changes, and he does not attempt to predict what the market will do next week or next month. Short-term movements mean very little to him. Instead, Buffett asks a much more meaningful question. Will this business be stronger 10 years from now? He focuses on the long-term health of the company rather than short-term market reactions. If the answer is yes, temporary price swings become unimportant. Time, not timing, becomes the key factor. The stock market itself is highly emotional. Prices rise and fall based on fear, excitement, news headlines, and investor mood. These emotions often have little to do with the actual performance of the businesses behind the stocks. In contrast, real businesses grow slowly. They expand their customer base, improve efficiency, and increase earnings over long periods of time, not overnight. Short-term thinking often leads to poor decisions. Investors panic when prices fall and rush to sell. They become overly confident when prices rise and buy impulsively. Long-term thinking, on the other hand, allows one of the most powerful forces in investing to work: compounding. Compounding occurs when your gains begin to generate gains of their own. At first, the progress feels slow and almost unnoticeable, but over time, the growth accelerates. Years of steady compounding can produce results that seem extraordinary, even though the process itself was calm and gradual. Buffett's greatest advantage was never intelligence or luck. It was patience. He understood that time does the heavy lifting when you own good businesses. By staying invested and allowing compounding to work uninterrupted, he achieved results that short-term strategies could never match. His thinking is captured in a simple rule: if you wouldn't be happy owning a business for 10 years, you shouldn't own it for 10 minutes. Rule 5. Protect your capital. This final rule is simple, but it is often misunderstood. Warren Buffett has summarized it in 2 famous statements. Rule number 1 is never lose money, and rule number 2 is never forget rule number 1. These words are not meant to suggest that losses will never happen, but rather to emphasize how important it is to avoid permanent damage. Protecting your capital does not mean avoiding all risk. Risk is unavoidable in investing. Instead, it means avoiding unnecessary risk, the kind that comes from overconfidence, ignorance, or emotional decision-making. Buffett understands that opportunities will always return, but lost capital may not. Protecting your capital means never investing money you cannot afford to lose. It means staying away from debt-driven investing, where borrowed money magnifies mistakes. It means operating strictly within your circle of competence, where your understanding is strongest. And it means resisting the temptation to chase quick profits, which often come with hidden dangers. Losses hurt far more than gains help. This is a simple mathematical reality. A loss of 50% requires a 100% gain just to return to where you started. The deeper the loss, the harder the recovery. Buffett keeps this reality at the center of every decision he makes. Because of this, Buffett avoids situations where a single mistake could cause permanent damage. He does not seek constant victories or dramatic wins. He doesn't need to be right every time. Instead, he focuses on avoiding large losses that could take him out of the game entirely. In investing, survival comes first. If you protect your capital, time and discipline can do the rest. Final thoughts. You don't need to be a genius to invest successfully. You don't need perfect timing, secret information, or complex strategies. What you need are qualities that are far more important and far more difficult to master: patience, discipline, and humility. These traits matter more than intelligence, because investing is not a test of how much you know, but how well you can control your behavior. The market will test you. It will test your emotions when prices fall and fear takes over. It will test your confidence when prices rise and excitement fills the air. It will try to rush you into decisions and tempt you with shortcuts that promise fast results. In those moments, it is easy to forget long-term goals and abandon sound principles. But the rules you've heard today are timeless. They have worked across decades, across different markets, and through countless economic cycles. They work not because they are clever, but because they are grounded in reality. They respect how businesses operate, how people behave, and how time rewards patience. If you remember these 5 rules, understanding the business, seeking lasting advantages, buying at reasonable prices, thinking long-term, and protecting your capital, and apply them steadily over time, you'll be building far more than financial wealth. You'll be building confidence in your decisions, clarity in your thinking, and control over your financial future. Thank you for listening and for taking the time to learn. And remember, the best investment you can ever make is in understanding.